Disclaimer: December 13th, 2025, 3:47 p.m. Eastern Time. Silver trades through $67 per ounce. Nothing explodes on television. No red banners. No emergency interruption. No anchors leaning forward in their chairs. To the public, it's just another price tick. But inside the risk engines of 8 of the largest banks on Earth, something else happens entirely. Alarms begin firing quietly, not on trading floors. Inside code. Within 90 seconds, automated systems initiate emergency protocols that have never been tested in real time. Not because silver went up, but because $67 means something. A number almost no investors recognize. A threshold almost nobody knows exists. A mathematical tripwire buried deep inside the plumbing of commodity markets. From that instant, the banks are no longer trading. They are counting down 72 business hours. That's all they're given to choose between 3 outcomes, each worse than the last. Option 1. Post $891 billion in immediate cash collateral. Option 2. Begin forced liquidation of 421 million ounces of silver they do not physically possess. Option 3. Trigger the first full-scale banking crisis of 2026 before Christmas even arrives. There is no fourth option. There is no negotiation. There is no pause button. The clock starts ticking on Friday. Today is December 19th. There are 48 hours left. And here's the point most people still don't understand. This has nothing to do with silver going up because people want it. This isn't sentiment. It isn't hype. It isn't speculation. This is not a story about enthusiasm. This is a mechanical failure. A trap constructed years ago, under the assumption it would never be reached, now snapping shut with perfect precision. The entire system activates at one exact level. Not $70, not $75, not a psychological round number. $67.25 per ounce. That number matters more than any headline price in global markets right now. Because once it's crossed, the system doesn't ask questions. It executes. And to understand why, you need to see the rule that was designed to prevent a crisis, and why it now guarantees one. In March 2023, the Chicago Mercantile Exchange COMEX, where global silver futures are cleared, made a change. There was no press release, no public hearing, no headlines. Just a quiet update buried inside procedural language so dense it reads like legal anesthesia. Rule 4.07b, the Enhanced Margin Liquidation Protocol. On paper, it sounds responsible, prudent, protective. In reality, it's lethal. The rule states that when volatility-adjusted price movement exceeds 285% of the weighted average short entry point for systemically important participants, those positions must be fully collateralized in cash within 72 business hours, or they are automatically liquidated by the exchange. Strip away the legal language, and here's what it means. If major banks shorted silver around $22 to $25 between 2020 and 2023, and silver rises to roughly 3.85 times that level, they must immediately post 100% cash collateral, not margin, not offsets, not paper hedges, cash. Fail to do so, and the exchange liquidates the position automatically, regardless of market conditions. Why would COMEX create a rule like this? Because in March 2020, the silver market nearly broke. Retail investors didn't just buy contracts, they demanded physical delivery. And for the first time, the system was exposed. There wasn't enough metal. Paper promises far outnumbered real ounces. Delivery queues stretched. Confidence wavered. The exchange survived, but barely. Behind closed doors, regulators made a promise to themselves. Never let positions grow so large they can't be unwound again. So they installed a circuit breaker, an automatic kill switch designed to force liquidation early, before pressure could escalate into systemic collapse. The logic seemed flawless. If prices ever rose too far, too fast, the rule would force banks to exit before the market destabilized. What they didn't account for, or chose to ignore, was synchronization. Because this rule doesn't unwind positions gradually. It doesn't stagger exits. It forces every trap participant to act at the same time. The moment the threshold is crossed, all discretion disappears. Algorithms issue margin calls simultaneously. Risk desks receive identical instructions. Liquidity demands spike instantly. The rule meant to prevent a squeeze now manufactures one. And the most dangerous part? The trigger isn't where most people think it is. On paper, a 285% move from an average short entry around $22.40 points to prices closer to $86 per ounce. That's the number analysts quote. That's the number that lulled everyone into complacency. But the banks didn't short silver with cash. They used leverage. And once leverage and regulatory buffers are applied, the trigger collapses downward. Not gradually, abruptly. The math resolves to a single number, $67.25 per ounce. At 3:47 p.m. on December 13th, silver prints $67.30. The line is crossed. The protocol activates. Automated margin calls are sent. And a countdown begins. Once the tripwire is crossed, the damage is no longer theoretical. It's measurable. According to December 2025 bank participation data, the exposure is concentrated and lethal. 8 banks, a combined 421 million ounces of short silver positions. At $67 per ounce, mark-to-market losses already exceed $18.7 billion. But that number is a distraction, because those shorts are not isolated bets. They are embedded deep inside a far larger structure, a web of offsets, swaps, and cross-collateralized positions that most investors will never see. That web is worth approximately $891 billion. Pension funds, commodity index products, sovereign reserve allocations, mining hedges, derivative overlays layered on top of derivative overlays. Silver isn't just a metal inside the system. It's a load-bearing asset. If it fails, the stress doesn't stay in the silver market. It propagates. Margin calls cascade across unrelated desks. Collateral is pulled from otherwise stable positions. Liquidity evaporates where no one expects it. This is why the banks can't simply take the loss. Posting $891 billion in cash isn't just painful, it's destabilizing. Liquidating 421 million ounces they don't physically have isn't just embarrassing. It's impossible without detonating price. And choosing neither option doesn't delay the crisis. It starts it. For years, banks controlled silver using a simple, brutal formula. Whenever price threatened to break out, they flooded the market with paper. Not metal, contracts. Promises of silver that didn't need to exist physically. It worked because paper supply was infinite. Until December 13th, that Friday, banks executed the playbook. They dumped contracts representing hundreds of millions of ounces. Price dipped. Then something happened that has never happened before. It recovered. They hit it again. And instead of collapsing, silver surged. By 3:47 p.m., price was back above $67 and holding. For the first time, every paper ounce sold was absorbed by buyers demanding real metal, not rollover, not cash settlement, delivery. That moment marked the end of infinite suppression. Because when paper supply meets physical demand, the illusion collapses. What we are watching now isn't a rally. It's the system discovering its own limits. And once those limits are reached, there is no graceful exit. Only forced decisions. And a clock that doesn't stop.